All right, let's get right into it. When the Federal Reserve cuts interest rates, it's so much more than a news headline. It's basically a starting gun. It kicks off this massive and, as you're about to see, incredibly predictable shift in the stock market. And we've got the data-driven playbook to walk you through it. That single move from the Fed means a whole new set of winners and losers is about to be crowned in the market. So the billion-dollar question is, who are they? And how can you get ahead of that wave, instead of just chasing the gains after they've already happened? And boom, here's the core of the answer, laid out perfectly. Rate cuts create this perfect seesaw effect. They're like rocket fuel for those high-growth tech stocks. But at the same exact time, they can sink sectors like energy and other cyclical stocks that really need a red-hot economy to do well. Okay, now let's get into the hard data. This all comes from the financial research platform fffinstill, and it proves that this rotation we're talking about, it isn't just a fun theory. It's actually one of the most reliable and powerful patterns you'll find in the entire market. I mean, just look at these numbers. They are incredibly clear. When rates are getting cut, the tech sector just runs away with it, posting a massive 17% average return. And who's at the very bottom? Energy. It's the undisputed loser, dropping over 16%. It is a total, complete reversal of fortunes. And this is the crucial part right here. It's a perfect mirror image. The relationship isn't just random. It's really a mathematical thing. It's all about how these companies are valued. When rates go down, future profits are suddenly worth more today. And that's a huge, disproportionate benefit for growth and tech stocks. So let's zoom in a bit. We're going to move from the sector level to individual companies, and I bet you'll know a lot of these names. This is where the pattern just gets even more stark. It's wild. The winners are exactly who you'd think they'd be. High-growth, long-duration stocks like Palantir, SoFi, and Carvana. These are companies whose big payday is way out in the future. But now, look at what happens to them during rate hikes. It's just painful. Their incredible gains during cuts are the polar opposite, which just shows you how sensitive they are to this one single factor. And on the flip side, the pattern is just as strong, if not stronger. Get this, a staggering 17 of the 18 worst performing stocks during rate cuts are all in the energy sector. These guys thrive when commodity prices are high and the economy is strong. So the moment rate cuts signal things might be slowing down, bam, they get hit the hardest. Okay, so what's really cool is how you can take all this data and turn it into a clear, actionable strategy. Because it's not just about knowing who wins, right? It's about knowing when they win. The fffinstill playbook actually breaks it down into 3 distinct phases. So right away, in phase 1, you rotate into those high-growth stocks. Then, as the cycle matures a bit, you start adding in fintech and consumer names. And finally, you shift toward quality, profitable growth and dividend payers, as that initial burst of excitement starts to fade. So what does all this mean for the market right now? As we look ahead to the next potential cycle of rate cuts, the big question is how we can apply this playbook in real time. I think the most important thing to take away from all this is that a rate cut isn't just a one-and-done event. No, it's the start of a whole new environment, a new regime with a totally different set of rules. And understanding this pattern, this predictable rotation from energy to tech, is absolutely critical if you want to navigate it successfully. And look, all of this incredible analysis is powered by fffinstill.com. What they do is track these economic regimes in real time across thousands of stocks. They actually tag every single trading week so you can see with your own eyes precisely how stocks behave in all these different environments. Seriously, if you want to stay ahead of the curve on big market shifts like this one, you should definitely follow fffinst and go check out their site. They've got over 300 free deep dive learning concepts just like this one, and everything is backed by hard data. Which leaves us with one final thought. As the Federal Reserve weighs its next move, and the entire market seems to be holding its breath, will this proven, data-backed playbook once again be the key to unlocking the next market cycle? The data seems to suggest it will be.